Good afternoon. It's Jeffrey Christian. It's a little after 12:15 in the afternoon here in New York on Friday, the 18th of April. A lot of ground I want to cover today. The gold price, the New York market, the futures market is closed today. London is closed today. London will also be closed on Monday for Easter Monday. New York will be back open. The price of gold did get up in the overnight market to close something over $3,370 an ounce. It's come back off in the over-the-counter market. It's probably trading around $3,325. Silver's trading around $32.50 as I speak in the over-the-counter market for those people who are still trading and not taking the day off. There's a lot of things that people are concerned about, and one of them is the May Comex silver futures roll. We've talked about that over the last several weeks. I want to talk about why it may or may not matter, and maybe explain it a little bit better. I want to talk about the bond markets, the dollar, budget deficits and debt, and the April 20th and the Insurrection Act. These are all issues that are causing a lot of anxiety on the part of some observers and investors, and I just want to sort of run through them, and then we'll talk a little bit about the precious metals markets update. So the May Comex silver futures contract, at the end of March, there was 619 million ounces of open interest in the May contract. Of that, more than half has already been dispensed with. 185 million ounces has been rolled from the May contract to the July contract. So you can see the end of March, May 619 million ounces, July 152 million ounces. Fast forward to yesterday, you had 280 million ounces left in the May contract, which becomes deliverable on April 30th, 8 trading days from today. And of that dispersion of May contracts, a lot of it has gone into the July contract. So the July open interest is now 337 million ounces as of yesterday. So you've had 185 million ounces of May futures contracts rolled into July. You've had another 15 million ounces of April contracts. I shouldn't be counting them here, I realize now, that have been delivered in the New York market. And then you had closeouts, people simply buying back their short and or long positions in the May contract of about 138 million ounces. Plus, you should throw that 15 million ounces in there. So it's 150 million ounces of closed out May contracts. Sometimes the shorts keep their short positions in an active contract up until the delivery period. Sometimes some portion, less than 1% typically, of the shorts actually want to deliver into an active contract. Usually they roll forward because most of those short positions are hedges of ongoing physical positions that they have. So they'll simply roll forward. But maybe 1%, maybe some slightly greater percentage will actually deliver into the delivery month. But most of it tends to roll forward. Sometimes the roll goes long and right up to the delivery period, and you can see the price of a commodity depending on which commodity it is, because this is not unique to silver or silver and gold. This is how commodities futures markets actually operate. You can see the price spike higher, and there are some commercial reasons why that happens, and then it's behind the market and you go back. We've seen more than half of the May open interest roll in the first two and a half weeks of April. It's not clear to us whether or not the open interest and the roll will have a major effect on silver. We have been saying for several weeks that we could see the silver price spike up to $35 based on the roll and then come back off toward the end of April into early May. That's what happened in 2011. it's not quite clear that we'll see that. We have seen, 6 million ounces delivered in the gold active April gold futures contract. And as I said, 15 million ounces delivered in the April silver contract, which is a little bit large. That represents a variety of things, including the fact that the arbitrage between New York and London has reversed. So you're now seeing gold being shipped back to London from New York. In addition to that, you continue to see stronger demand for gold and silver in the United States and Canada, in North America, than you're seeing in Europe. So some of these deliveries may be meeting physical demand within North America. Although I have to say, most of that metal has stayed in the depositories. That would suggest that it's not so much active physical metal for use in industrial manufacturing, jewelry or electronics or other applications. It's probably more investor demand that you would be seeing taking delivery of these futures contracts and leaving the metal in those depositories. Now, the bond market, people have been very histrionic, talking about how the Treasury market is collapsing because of tariffs and because of anti-U.S. sentiment on a global basis. That's not really true. It is a matter that the Treasuries are losing some of their preeminence. There is a growing hostility toward the U.S. government on a global basis as well as a domestic basis. We saw this to some extent in 2009 after the U.S. Treasury they bailed out the U.S. banks at the expense of everybody else, including Treasury holders of Treasury securities. And you saw a little step down in 2008, 2009 because of that. You saw another step down in 2011 when Treasuries were downgraded by the credit rating agencies because of the growing debt and deficits. So it's a matter of the Treasuries losing some of their preeminence, but they still maintain a tremendous amount of favor on the part of international and domestic investors. It's not a black and white issue. It's not that the Treasury markets are going to collapse. It's a movement along a spectrum of shades of gray that you're seeing there, which is really how markets work. I know a lot of commentators like to talk in terms of black and white. Things are going to collapse. The dollar's going to collapse. Gold's going to collapse. Gold's going to skyrocket. Black and white things like that, the overly simplistic views of the world and financial markets. You have to pay attention to the spreads between treasuries and other debt instruments, including other government sovereign debt and corporate debt. And I'll show you some slides in a second. Unfortunately, I don't have a slide that I think easily compares other government sovereign debt to U.S. debt right now. But what you've seen is because we have a stronger economic environment right now in the United States, U.S. Treasuries tend to be being priced at prices higher than most other countries' interest rates. I think the UK may still have rates that are somewhat higher than the United States, but Germany, Japan, France, other major economic power industrialized countries have lower sovereign rate interest rates, and they also have less desire on the part of international investors to hold those. So what you're seeing is the continued focus on treasuries. I'll show you some stuff in a second about that. So you have to pay attention to those spreads because the spreads are extremely important in terms of the transmission of information about what financial markets expect from corporate borrowers and other various governments, and what's going to happen to those corporate borrowers and other governments. The bond market, and the bottom line, is not collapsing. It's doing exactly what it's supposed to do. This is a comment from the Fixed Income Clearing Corp, which clears U.S. Treasuries on a global basis. And you've seen a tremendous amount of activity in the U.S. Treasury markets, and they cleared $11 trillion in one day on April 9th. And they've been clearing enormous amounts, trillions of dollars of treasuries every day, demonstrating that the market really, it may be under stress, and there may be a lot of people who are worried about various things, but the Treasury market is still functioning, and it's still functioning in a liquid way. You may not like what you're seeing in terms of Treasury prices and Treasury interest rates, but that doesn't mean that the Treasury securities are not being priced accurately by the diverse entities that are involved in that market. This is the 10-year Treasury less the 2-year Treasury. This is how my market standard thinks about the yield curve. And you may remember, 2021, 22, 23, there were any number of pundits that were saying, oh, we have an inverted yield curve. The 10-year yield is less than the 2-year yield, and that means that there is going to be a recession imminently. We talked extensively about how that was not an accurate reading, how if you look at it historically from World War II to 2008, which is what everybody was talking about, you would see that the inverted yield curve presaged a recession sometimes. Sometimes it presaged a recession 2-3 years before the recession hit. Sometimes it didn't presage it, it post-saged it 2 or 3 years after the recession was over. And sometimes it occurred during the recession. After the financial crisis of 2007, 2009, all that changed, and the relationship broke down further. So we got into this inverted yield curve. A lot of people were predicting an imminent recession. It didn't happen. It could happen. We're expecting a recession later this year, early next year, depending on how the political and economic environment unfolds. So maybe it did precede a recession by, 5 years, 4 years, 3 years, whatever. But this is what people are looking at. We have, as I said it's even less relevant and predictive since 2008, because the relationship between the Treasury market, the debt market, interest rates, and overall economic activity have changed. One of the things you got to look at is the relationship between the Treasuries and corporate debt. Now, this is the Moody's BAA corporate bond index yield relative to 10-year securities. And we had been saying again for several years that the risks associated with corporate debt were being underpriced, that there was a enthusiasm for it, debt that allowed corporate borrowers to borrow vast sums of money from institutional investors and others at rates that were like 1.5% to 2.5%, less than 2.5% above the 10-year Treasury rates. And that seemed very low. And you can see how, prior to 2020, unfortunately, the Fed data that's readily available only goes back to 2020. I didn't have time to grab earlier stuff. But you could see that historically, the premium for corporate borrowers over 10-year treasuries was up there 3%, 3.5%. And it came way down, and now it's gone back up. It's gotten all the way up to 2%, which is still probably underpricing corporate debt. That tells you that, people are probably focusing more on borrowing from the Treasury. But it also means that there's still a lot of borrowing capacity on the part of business should they need to borrow more money. And we can see that in that every day we get various corporate bond offerings solicitations early in the morning. They usually don't have an interest rate or a volume attached to them. And they usually get subscribed and filled before lunchtime. Tremendous amount of money in cash, and you see that cash readily willing to buy into corporate bonds in an incredibly understudied fashion, to put it nicely. This is slightly different. This is corporate debt compared to the Fed funds rate, and it's basically the same thing. You actually saw at one point corporate borrowers paying less than the Fed funds rate was paying, and it's come back up, but it's still only about 1%. Turning to the dollar, it's not falling. It's not collapsing. It's falling. Okay, the dollar peaked a few months ago, a few weeks ago, really, and it's fallen 2.4% since then. It's fallen all the way back to where it was last October, just before the U.S. election. It's still 15% higher than it was at its July 2021 low, and it's 47% higher than it was at its July 2011 low. That's when the Treasury market actually had its credit ratings downgraded by the credit agencies. And the dollar is 47% higher. Now, was it overly confident and too high in February? Probably. It's come off. It's not exactly collapsing, but it has come off. So a little bit of perspective, a little bit less caffeine, and we're all happy. Now, the federal budget deficits and debt. The Congress has passed a budget continuing resolution that the Trump administration told it to pass, and it capitulated and did it. And that budget legislation is expected to add $580 billion per year to U.S. government federal spending and to the budget deficit over the next decade. Now, in January, prior to that, but anticipating problems and issues with the incumbent Trump administration, the Congressional Budget Office, which is this nonpartisan economic research group that takes legislation and says, this is what it's going to cost. In January, they said that the budget could expand from $1.7 trillion in fiscal 2025 to something on the order of $2.6 trillion in 10 years by the fiscal 2034. And they said that's before accounting for whatever changes the incumbent Trump administration might make. Those changes are now in place. They're expected to add $580 billion on average to the budget deficit each year over the next decade. That takes that budget deficit to $2.4 trillion in 2025 and $3.2 trillion deficit in 2034 if nothing changes. That would be, even before that, it's $21 trillion added to the federal debt, which is about $36 trillion. So going from 36 to 57. But the Trump budget, should it remain in place for the next 10 years, would add another $5.8 trillion to it. So that would be $27 trillion added to the $36 trillion that we already have, assuming that everybody was willing to buy these treasuries to pay for those deficits. Yeah, and I said, don't worry, because these projections usually grossly underestimate both deficits and debt. Put it all together, what it means is, yes, government has a spendthrift behavior, and the world has been financing it. And there are indications the world will probably continue to do it. Here's a really interesting YouTube video. It's only about 2.5 minutes long. It's Milton Friedman from a long, long time ago, talking about 2013, it says, talking about the role of trade balances and tariffs on economics. It ties in with things that we were saying in our earlier video on Tuesday of this week and our video on the previous Friday. But it's worth watching for 2 minutes and 45 seconds. Now, there is some amount of anxiety that the Trump administration could invoke the Insurrection Act of 1807, and they could do it really at any time. There's a tremendous amount of misunderstanding about what the Insurrection Act is and what the Trump administration situation is. But on January 20th, the first day that he was in office, his inauguration day, Trump signed an executive order asking the Defense Department and Homeland Security Department to study the crisis on the southern border and determine whether what could and should be done about it, and to decide, including what could and should be done, and should the president invoke the Insurrection Act of 1807. Now, that doesn't impose martial law. What it does is it gives the White House and administration the right to use the U.S. military domestically to support private, or not private, but state and local police and other activities, and to direct the military how to do that. There are a lot of people who are concerned about that. They think that, and that executive order on January 20th said, the departments should report to them within 90 days, which takes it to Easter Sunday, April 20th. And there are people who think that Trump might get this report from the departments and invoke the Insurrection Act on that day. Nothing in the executive order says that it has to be on that day. It would simply say, oh yeah, you're right and you're empowered and you probably should invoke the Insurrection Act. So he could do that at any time. And in fact, he could have done it at any time already, because you don't need the Department of Defense to authorize the president to invoke the Insurrection Act. So there's a lot of misunderstandings about what the Insurrection Act is and what it means. It has been used a couple times in the past. Abraham Lincoln used it during during the Civil War. President Eisenhower used it to support sending in federal troops to help desegregate schools in the South, starting in Arkansas, Brown versus Education, where the government of Arkansas simply said, we're not going to desegregate our schools. So Ike sent in federal troops and said, yes, you are. I think that was probably the last time the Insurrection Act was used. JFK sent in some troops to help desegregate some universities in the early 60s, but I don't know that he actually invoked the Insurrection Act to do that. But that's out there. People keep saying that a lot of Americans are worried about this, but there's no percentage that I have been able to find. They just say many, and many is not a number. You can't quantify that. This is a link to a very straightforward, I think it's probably about 6-minute discussion by somebody, probably a lawyer or a legal scholar. She does an excellent job of giving a very straightforward explanation of all of this and a nonpartisan explanation. So you might want to visit that too. It's a good Easter morning type of thing to watch. Let's talk about the markets a little bit. Gold has reached record levels. It's shot up to record levels again this week. As I said, $3,370 some odd dollars at one point for the, I guess that's a June contract. And you're looking at an economic and political environment that is fraught with uncertainty and is generating tremendous anxiety, as well as a social environment too. So as long as that continues, people are going to be buying gold, as well as treasuries and the dollar. and silver, right? So you should expect the price of gold to stay high and maybe even move higher over the whatever period of time this constitutional crisis that's emerging goes on. That doesn't mean that you might not see profit taking. We saw the price of gold drop $250 or so in a couple days, a couple weeks ago. And then it came right back and then it rose another $170 on top of that. So it's not to say that you can't see periods of sharp declines in profit taking. And it's not to say that you can't see a period of time where people start normalizing the current economic and political anxieties and uncertainties, and you see the gold market calm down. As I said, you have a situation right now where you've seen a lot of investors back away from buying gold at such high prices, and you're seeing a surplus of metal, short-term surplus of metal, sloshing around the New York market, as well as in other places. So you could see the gold price back off. Yeah, our expected range, I think, for the next 3 to 12 months is probably something like $1,260 on the low side and $3,500 on the upside. Don't hold me to that, but we have this enormous range because we expect enormous volatility, because we expect enormous swings in the political, economic, and social environment, not just in the United States, but domestically in a number of other countries that are suffering from various issues domestically and on an international basis. It's an interesting time to be alive, and that's going to be reflected in high gold prices until it's less interesting to be alive. Silver, same thing. It hasn't performed as well. That's because silver primarily is an investment in North America and India. Around the world, when things are bad as they are now, or uncertain and risks are very high, people will turn to gold. They'll also turn to the dollar and treasuries and silver, but fewer people turn to silver than turn to gold. And so you've seen gold prices continuing to rise and reach record levels, while silver prices have risen, but not as sharply, and they haven't gone back to their intraday highs. On an annual or quarterly average basis, they're pretty much back where they were on a quarterly average basis in 2011, which was the aftermath of the global financial crisis, the Great Recession, and the height of the sovereign debt crisis in which the U.S. Treasury was downgraded, and you had problems with Greek sovereign debt not having trouble rolling it forward at that time, along with sovereign debt of various other countries. So you're seeing stronger silver prices, but not as strong as gold, and that reflects again the fact that you have a tremendous amount of silver around, not only in the New York market, but really on a global basis. And investors are more interested in gold right now than silver. Platinum prices have, I put in for platinum and palladium, the smaller charts go back to 2015. Platinum, to show you that the price has really been trading between $800 and $1,100 for most of the last decade. A couple spikes below that, a couple spikes above it. We got down to $900. We broke below $900 a couple weeks ago. The price has come back up to that midpoint of that range of $900 to $1,100. And that's sort of where we are with platinum. And the same is true in terms of the short term with palladium. You've got this range-bound palladium price over the last 18 months or so. But the palladium price had risen very sharply from 2017 into 2021-22. And since then, it's come down. Both platinum and palladium are primarily industrial metals. Their major uses, like 50, 60% of their fabrication demand is in auto catalysts. The auto industry is suffering from a number of both short-term cyclical and long-term secular reductions in demand, and that's being reflected in these lower prices. That's what I got for you. We issued our gold yearbook at the end of March. You can purchase it and download it as an ebook at our website. Costs $160. We will be coming out with our silver yearbook in late May and our platinum yearbook in late July. We're working on the silver yearbook now. And we will continue to do these videos where we address not only the realities of these markets, but also address some of the things that aren't real in there. We have a retail investor program, which is a lower price point way for retail investors to plug into CPM Group's research and consulting services. You can read about it at our website and at this link. You can go to our website. You can pre-order the silver yearbook, the platinum yearbook. You can buy the gold yearbook. You can subscribe to our precious metals advisory monthly. You can subscribe to the retail investment program. There are also tons of free reads and free videos there, as well as information about CPM Group and what all we do and what all we can do for you. And if you want to discuss what we can do for you, you can send us an email at info@cpmgroup.com. That's all I have for now. Have a good weekend. Have a pleasant time. If you're in the Northern Hemisphere, I hope you're getting some spring weather. If you're in the Southern Hemisphere, I hope you've got some nice autumnal weather. I think autumn is my favorite season. Be good to yourself. Be good to those around you, and try to do something good for the world. And we'll see you next week.